Thank you for joining me on this video. My name is Rodney Constable. I'm the president of Simple Market Signals, and today we're going to be doing technical analysis on the S&P 500 for Friday, February 14th, 2020. So the week ending February 14th, 2020. First thing to note is we were up slightly today on the S&P 500, up a little less than 0.2%. We were up 0.18%. So all in, not too bad of a day. Oftentimes I see that Fridays are down days, so the fact that we finished positive today is a good thing. Now let's go ahead and set up the annotation tool, and let's take a look at some support and resistance levels here. The first one is going to be kind of hard to see on a short term or on a 1 day, 1 year chart. So this each vertical bar, each candlestick is representative of 1 day, and this chart goes back to for 1 full year. But you'll see as we change into different time frames, you'll see that this 3370 area really does come into play. But so it's kind of hard to see right here, but just kind of keep that in mind as we go through this. Another area of support and resistance is going to be around this 3330 and then 3320 level. So again, as we get into different time frames, it might be a little easier to see this, but just kind of keep this in mind. And we can see here this green line is the 20-day moving average, and the 20-day is just below that 3320 area at this point. So kind of keep that in mind, and then there's some support and resistance around 3,300. And then as we go down, if the market, if the market does fall anytime soon, another real key area is going to be this 3220 area. And you can see here that once we got above this in the middle of December, we've stayed above it. So middle of December here, 2019, you can see we got above that 3220 area, and it has acted as an area of support. And as a matter of fact, here a couple of weeks ago, when the fears of the coronavirus first came out, and you can see here where the market corrected, and it corrected right down and kind of kissed this 3220 area, but never closed below it. So we have not closed below this 3220 area since, as you can see here, about the middle of December. So that is a key support area for right now. And you can see here the blue line is the 50-day moving average. So this 3220 area is a little bit below the 50-day, which is going to show up around 3250 right now on the charts. Another thing about the 50-day moving average, you can see once we cleared the 50, kind of right in the middle of October of 2019, we have been above the 50-day moving average for this entire run. This has been an absolutely incredible run, and we pulled back below the 20-day moving average, again the green line, a couple of times, just for basically 1 day here, and then a few days here. We closed between the 20-day and the 50-day moving average, but this run since the middle of October has been unbelievable, and we're up over 16.5%. During since the beginning of October. So it's been an absolutely incredible run. The other thing that I have been looking at here is the distance we are above the 200-day moving average. And let me grab my calculator here real quick, guys, and take a look here. So we've got the 200-day moving average setting at 30.3261, and we closed at 33.8016. So let's take 3380.16 minus 32.61. That's 347.55 points above the 200-day moving average. We will divide that by the 200, and we're setting at 11.46% above the 200-day moving average. Now, went back and looked at different time frames going clear back in the 1990s, and it's not unusual for us to be this 11.46% or so above the the 200-day moving average. It does happen, but just keep in mind that it's a pretty big move. We're quite a ways above the 200, so just kind of keep that in mind. That if we do get a pullback, I mean, if let's say for instance Monday, whatever, something happens over the weekend, and we get a pullback to the 200-day moving average, that's 11.5% basically pullback. Now, I don't think that's going to happen anytime soon, but a pullback to the 200-day moving average is not unusual. It doesn't happen every year. There's a few years like 2013 and 2017 that we had no pullbacks to the 200-day moving average. And you can see here in the kind of the left side of the chart here, you can see that the last time we visited the 200-day moving average, again, that's this gold line here, this orange gold line. The last time we visited the 200 was back at the end of May, beginning of June. And then we were back here a few months prior to that, around April, May timeframe, we kissed the 200 as well for just a couple of days. So a pullback to the 200 again would be a pretty hefty drop right now. And keep in mind that anything over a 10% pullback is called a correction, and of course a bear market is when you fall 20% or more from your recent all-time highs. So just kind of reviewing some basics there. Now let's continue on with support and resistance levels here on the yearly chart, where again each candlestick, as these are called, is 1 day. And let's take a look at some other areas here. And the last one we looked at was 3220. So that's probably the 3220. Before I move on, I just want to review this. The 3220 level is probably right now the most important support area that we have. So again, it's just below the 50-day moving average, which, as you can see, we haven't been below the 50 since the middle of October. So even a pullback to the 50 would be a big deal at this point, and a pullback to 3220. That would be a pretty good pullback, okay? I mean, it would be significant. So keep 3220 in your mind. We definitely don't want to see the market go below that, because that would not be a healthy sign, at least in the short term, okay? 3,200, 20 points below, would also provide some area of support. And then you can see here we've got some more trading around this 3120 area. And as you've probably heard me talk about in the past, if you've seen any of my other technical analysis videos, round numbers, in this case 3100, where I just drew the last line, the round numbers psychologically can oftentimes provide support and resistance. And you can actually see it right here, where in November of 19, we got up to this 3100 level, and we traded up to it for several days before we finally went above it. And you can see that overhead resistance becomes support once penetrated, okay? So this, the 3100, again, the round number, provided a psychological ceiling above where we were trading back in November. Once we finally got above that, we have been able to stay above it, except for 1 day there during the first week in December, okay? So for all but 1 day, we've been above this 3100 level once we got above it. Okay, so again, round numbers, and a guy named Jesse Livermore wrote about this. He was a famous trader a century ago who made a ton of money, one of the best traders ever. If you don't know who Jesse Livermore is, if you're so inclined, go out and look the guy up. He was quite the character, and he made a ton of money in the markets, and I've learned a lot by reading his material. But he pointed out a century ago that round numbers oftentimes provided support and resistance. So 3100, and then you can see here, if we do fall all the way back down again towards this 200-day moving average, right now the 200 is setting at 3032.61, and you can see that there's a lot of support at 3020 as well. And so somewhere around this 200-day moving average, there's a ton of support, and again, the round number below that would be 3,000. So a pullback to this area would be quite significant at this point. I don't think that's going to happen anytime soon. This market is acting so resilient. Over the last few months, we've had a president impeached, we've had the coronavirus, and these markets have just been on an absolute tear. So nothing seems to phase this market. I don't think that's going to change anytime soon, but I have no crystal ball. So just be mindful of these different support areas. If and when the market starts to fall, these would be the areas where we would probably see the support come in for the market. So right now, I think the 3220 is probably the most significant. So if we do get a pullback, and we penetrate below some of these other areas that I pointed out, like the 3330 and the 3220, or 3320, excuse me, and the 3300 level, then the 3220 would definitely come into play there. And hopefully we won't see the market pull back any further than that anytime soon. So let me click out of this chart and let's take a look at some other time frames. So first off, let's, as I say, let's put the market under the microscope. Now what we're looking at here is, I'm going to pull this down a little bit so you guys can see this. This is a 5-day, 5-minute chart. So this is the entire week that we're looking at. So you can see where my cursor is. That's Monday, Tuesday, Wednesday, Thursday, and here's today's trading. Okay. So every vertical bar, every candlestick is a 5-minute movement in the S&P 500. So I call this putting the market under the microscope. I like to do this so I can see what's happened intra-day. Gives me more perspective. Now, I mentioned in that previous chart, the 1 year, 1 day chart, daily chart, that the 3370 area has been kind of a key area here, and it was kind of hard to see, but here's what I'm talking about. So once we got above, and you can see here, we opened up above on Wednesday, the 12th, we opened up above this 3370 area on the S&P and stayed above it that entire day, and then most of the trading that has happened the balance of this week, you can see we've kind of went sideways, right? Wednesday, Thursday, Friday, somewhat sideways in a fairly tight trading range where 3370, we penetrated it just barely here today, closed below it for just a couple of times, but you can see that the bulk of the trading has been above this 3370 area, and then on the high end, you can see there's going to be resistance somewhere. You can see that most of it's going to be 3380. So we traded a few, like 1 or 2 points above that, but basically, 3380, 3381. You can see the bulk of all of the trading, except for a few, a little segment here for hour and a half on Thursday where we traded above that 3382 area for about an hour and a half. But the bulk of the trading here, Wednesday, Thursday, and Friday, has been between 3370 and 3380. So that's very important to understand. And the good news is, even though we went negative, we were negative in the afternoon, this dotted blue line is where we opened, where we basically closed yesterday, right? So anything above that would be positive, anything below it would be negative. Again, that's that dotted blue line. But the fact that we closed towards the high end of this range that we've been in for the last 3 days, and we can see the bulk of the trading happened above this 3370 area. That's why I was saying on the previous chart that this 3370 area in the short term, in the near term, is a very, very important support area for the S&P 500. So let's click out of this and let's go into the hourly chart. So what we're looking at here, each candlestick is an hour in the S&P 500, and this is a 2-month chart. So 2 months and hour at a time. And again, just different perspective. We're going to look at a lot of the same data points, the same support and resistance levels, but on different time frames. And this is why I like to do this for my own work as well as when I'm educating others. It really helps on different time frames where you can really see these different areas. But you can see that this 3370 area kind of acted as an overhead resistance point for a few hours. Again, each one of these candles is an hour. And then once we got above it, all but 1 hour of trading has been above that 3370 area. So in the short term, the 3370 area is a very key support area. And then again, it's easier on this hourly chart to see the importance of this 3320 area. Again, you can see here, once we got above it, we pretty much stayed it, but it's acted as support and resistance. We fell beneath this during the first scare of the coronavirus, and then we've been back above this 3320 area for the bulk of February. So this is, again, provided some nice support in the markets. Okay, So hope you guys have enjoyed that, and let's just kind of take a quick look at around this 3220 area that I've mentioned, and you can see that the bulk of the trading here really since the first of the year, because here's the, right here, let me draw a vertical line so it's easier to see. That's the first of the year, okay? So virtually all of the trading of 2020 has been above, for the calendar year 2020 so far. All of our trading has been above this 3220 area, and you can see that we kind of pulled down to it, and then when we pulled back during this first, when the coronavirus first kind of made headlines, we pulled back to it, and towards the end of January, and we kind of closed. Where the wick is, or the tail on this candlestick, if you will, the wick's on the top, and the tail on this candlestick, you can see we dipped below it intraday, but we never closed below this 3220 really since the first of the year. So again, and over here in December, you can see that it acted as a support area. Again, once we got above this 3220, we traded really tightly, right there. 30. Let me get rid of that line there. Didn't want that there. I was trying to get a horizontal. There we go. And you can see that the 3230 area kind of acted as overhead resistance, if you will. But it's this 3220 area that I mentioned on the 1 year, 1 day chart that I feel is probably right now the most significant near-term support level to keep your eye on. So hopefully this has helped. Now, if you want to take your trading to the next level, okay, and if you would have liked the opportunity, now what we're looking at here is 2007, 8, and 9. But stick with me here. This is super important. If you would have liked the opportunity to been able to have some sign to sell in the first part of November of 07 at around 1,500 on the S&P, and to be able to stay out of the market for the bulk of this entire downturn, basically missing as much as a 40% drop in the market. Okay, the market fell more than that, but what I'm suggesting here, and stay with me because this will all make sense, what I'm telling you, and I opened up the video by telling you that I'm the president of Simple Market Signals, okay? And I developed for my own personal trading and investing, and I worked on this for over 20 years to figure this out. But I developed a model that allows me to look at risk in the U.S. stock market, and it addresses systematic risk. And this is something that hardly anybody talks about. But I developed a proprietary model for my own personal trading and investing. And again, I worked on this for over 20 years. It finally came together. I finally found the last pieces of the puzzle that I needed to make this work. And I tried all kinds of stuff, guys. I spent thousands and thousands of hours on this, but it finally came together for me in 2017. So what we're looking at here is back testing, but in back testing my model, the signals, and I distilled it down to green, yellow, red, just like a stoplight. So green means go, yellow means caution, red means stop, right? So the way this model works and the way I use it, I'm basically fully invested when the market is green, and pretty much I stay out of the market when it's yellow and red, because when it's yellow, you're kind of sideways to slightly up and down, and you're going to have a heck of a time making money. And when it's red, you're probably going to lose money, okay? And I hate losing money. So the signal in backtesting this, now that I have the model put together, and I went back and looked at what would have happened during the 07 through 09 downturn, the signal would have went red on the S&P 500 right around this 1,500 level. Okay. Now we had one rally attempt in the S&P 500 during the first into the middle part of 2008, where the model would have actually generated a green signal this week, and then the very next week that rally attempt failed, and the model would have generated a red signal. So you would have had if you use the model like I do, and I'll get to the signals, and and by the way, guys, do not worry about the cost of this thing, okay? I priced it too low probably for my own good, but anybody that's watching this video right now, I promise you, you can afford this, okay? Most of you probably spend more at Starbucks during the course of a month than what this is going to cost you, and I promise you that. Just stick with me. I'll get to the cost in a second, but I want you to understand what it does for you first and how important this is. It takes traditional technical analysis, which I hope I've already demonstrated I'm pretty good at, and I love it, and it really helps. However, this takes things to the next level. This will help you in whether you're trading the S&P 500 itself or investing in in other ETFs, stocks, options. This will help you because of systematic risk and correlations. Okay, and I have other videos on my YouTube channel that go deeper into that. Those topics, but stay with me on this one. So you would have had a rally attempt here. The signal went green and then failed, and then the signal would have stayed red through this entire period and finally went green here. So bottom line, if you were using my model, my simple market signals model, you could have gotten out somewhere around 1,500 on the S&P, and then you basically, other than this is called a whipsaw, by the way. When you get in and then get whipped out, it's called a whipsaw. You probably would have lost a few percentage points there, but you would have missed the bulk of this downturn. So this would have been, even considering the whipsaw, you'd have missed about a 40% drawdown. Now, folks, and you can go out and look at the math on this. If you lose 40% in an investment, it takes 66.67% to get back to even. Let me repeat that. If you lose 40%, whether it's in the S&P 500, in an individual stock, whatever, okay, you cannot afford to do that. Okay, you have to keep your losses as small as possible. The best traders on the planet, they live by one rule. Cut your losers, let your winners run. Let me repeat that. Cut your losers and let your winners run. And this is what this system will help you do. Not only does it help you cut your losses, but it will help you stay in the S&P 500 or whatever investment, right, because of the correlations. But it will help you stay in the market when the market is green, right, when the signal is green. And keep in mind what I pointed out earlier on this video, that since October, we've had the impeachment of a president. It's only happened a couple of times in history. Plus, we've had the coronavirus, right? These are things that normally would freak people out and they would get out of the markets. But the signal, other than a few short yellow periods, which I'll show you here in a second, has stayed green, okay? So not only does simple market signals help you with the opportunity to reduce your losses, right? Helps you hopefully lose a lot less with your trading, but it will also helps you stay in the trade irrespective of politics, news headlines, lagging economic data, or anybody's opinions, because it is market-based. Simple market signals is market-based. It's based on the U.S. stock market. It's free of anybody's opinions, including my own. There's no opinions, no forecasts, no lagging economic data. We don't look at headlines. We don't look at politics. It's just the U.S. stock market, okay? So this is what would have happened. Again, you could have gotten out somewhere around 1,500, got back in at about 875 on the S&P. That's 2007 you would have gotten out. You would have set out basically all but maybe a couple weeks of 08, and then you could have gotten back in towards the tail end of April of 09, okay? So that's back testing. Now, looking at real-world data, stay with me here. 2018. So as we go into 2018, the signal was green, okay, and then it went yellow towards the end of January of 2018. Now, I grouped the yellow and red signals together for 2018, for the bulk of 2018, just to kind of show you so it's easier to look at the chart. But if you were like me and you had very little, if any, exposure to the markets, to equities, when the signal is yellow and red, you would have set out this period of time. We had a very short green signal, went green here, and then it failed basically about 2 weeks later and went yellow. So in this type of a situation, you could have gotten in and out and maybe even lost a little bit. But remember what I said, cut your losers, let your winners run. To be a successful trader and investor these days, you have to keep your losses as small as possible. It's a game of mathematics, okay? You cannot afford to take big losses. You can recover from a small loss. It takes years. If you would have been fully invested, right, and during that 07 through 09 downturn, you lost over, well, at one point your drawdown would have been about 60%. But even if where my signals were, let's call it 40%. Again, it takes 66.67% return, right? That's how much you have to make just to get back to break even when you take a 40% loss on anything. So minimizing your losses and maximizing your gains is the key to winning as a trader and an investor. And that's what this system, Simple Market Signals, will help you do. Now, the signal went yellow, as you can see here, around the 18th of June in 2018, and then was yellow for a couple weeks and then went green here. So again, you can see this green signal is slightly higher than this yellow signal. What that means is you would have had to rebuy at a slightly higher price. Folks, that is the price you have to pay for insurance, if you will, the insurance of knowing that you're not going to take big losses, okay? And that whether you're using my system or any other system to mitigate risk and mitigate losses, you will, on occasions, have to buy back in at a slightly higher price than where you sold. And that's just the reality of a system like this, okay? But you can see here that the market was green for about 3 months, and then went yellow and red. And again, I batched this together. And if you go and look at the returns for 2018, you will notice that they're actually negative. So people that were fully invested during 2018 lost money, where somebody technically could have been invested about 4 months of the year, for the month of January and then kind of the middle of July through the first part of October, and they would have had a positive return using simple market signals, okay? And then in 2019, the signal stayed red until right here. So that's one thing I want you to understand. You know, this isn't a magic bullet, guys. It's not going to, you know, the market's going to bottom, and the markets generally bottom very quickly and start to bounce. And even though my system is very sensitive and the signals are sensitive, it will take a little while for the signal to go from red to green, okay? It's a conservative model. It's there to protect you. It's not going to pick the absolute bottom is what I'm trying to get, the point that I'm trying to get across here, okay? I'm having a hard time with my words today, so just bear with me. But so, you know, you would have missed a little bit of an upside here. Again, it's not going to pick the exact bottom. But I'll come back to this in a second because I want you to understand what it would have done for you. But again, this is calendar year 2019. So real quickly, the signal was green. Then it went yellow. Okay, so you could have sold out here, bought back in here. Again, you would have been able to buy back at a slightly lower price. That's a good thing. Green, yellow, another short yellow there, green. Now, this one would have been a little tougher. You may have kind of broken even to maybe even lost a small amount. So that doesn't happen a lot with the green signals, but it does happen. Again, you would have gotten in here, gotten out there, probably could have broken even, right? Then you would have sold here, and then again, you ended up, if you sold, and I send you the signals, I'll explain that in a second. You do with them what you want. However, if you're like me and you're predominantly invested in greens, setting out the yellows and reds so that you give yourself the best opportunity to make money with the least opportunity to lose money, you would have had a slight loss here where you sold out and bought back in at a slightly higher price. Okay, so anyway, really wouldn't have lost anything, but you would be buying back in at a slightly higher price. Market goes green, and then this is the shortest, since this model came together over 2.5 years ago. This is the shortest signal that I've had, and it was a 3-day yellow signal, and then we got right back into the green. Okay, so these things do happen. These super short signals like this are very rare, but they do happen. Okay, so you can use this to technically rebalance your portfolios. You can use it to trade. You can just use it to monitor, the markets for expectations. Some people are wired such that they are long-term buy and hold investors. Some people may want to be contrarian, and maybe, if you're a contrarian and you say, you know what, I'm a super long-term, I've got a 20, 30, 40-year time horizon. You don't care about the next, 6, 12, 18, 24 months. And some people are wired that way. I'm not that way. I hate going backwards. I hate it. But if you have a super long-term time horizon and you don't care about the next few years, maybe you would like to make the bulk of your new purchases when the signal turns red. That's another way to use this system. And for really ultra long-term buy and hold people, if you can stomach the short-term drawdowns, that's another way to use this, is actually use it in the opposite way of what I developed it, right? And you say, you know what, I'm just going to make the bulk of my new purchases when the signal is red. For a very long-term, value-oriented, deep discount value person, a long-term buy and hold person, that would actually work quite well, okay? So, Simple Market Signals. The website is https://simplemarketsignals.com. Folks, this is a weekly newsletter, Okay, I deliver it via email. I try to get it out on Saturday morning so you guys have the bulk of the weekend to look at it, but depending on the research that I'm doing for the newsletter, and it's not just about the signals. I throw a ton of information in here, but the heart of this newsletter is around the signals. And by the way, I give you signals on the S&P 500, which represents the entire U.S. stock market, but I also break down each of the individual sectors within the S&P 500. There's 11 individual sectors, so you get the signals on all 11 sectors, plus the S&P 500, and there's a ton of other valuable and very educational data that I put in these newsletters. I have financial advisors that subscribe to this, and they use this to help run their practice, guys. This is really, really good stuff. And it's $19.95 a month, okay? That's what I was saying. It's less than $5 a week. And on a 30-day month, it's less than 67 cents a day. This is the best information that I have to share with you, and it's $19.95 a month. You're going to get a weekly email, at least one, with the newsletter attached. And the reason I said at least one, if there is a major signal change in the markets during the middle of the week, right? The newsletter traditionally goes out on Saturdays. However, if there's a major signal change in the middle of the week, I'm not going to wait until the weekend to send out that information. I'm going to make sure you get it as soon as possible. So at the close of the market on a given business day, if there is on a trading day, if there is a signal change, I will send out what's called a special midweek update with just a brief explanation of the signal change from green to yellow, yellow to red, yellow to green, whatever it is, and I'll explain that, okay? Now, if you would like to join me, if you'd like to subscribe, the first thing you have to do, of course, is accept the cookies. It's standard these days, have to do that from a compliance standpoint, and then you click here to get started. It'll take you 5 minutes or less to sign up. The first 2 weeks are free, if I didn't mention that, so it's $19.95 a month. The first 2 weeks are free. There's no contracts. You can cancel at any time, so give it a try for a couple months. If you don't like it, just cancel your subscription, okay? It's pretty easy. First 2 weeks are free, and then it'll be automatically billed to your credit card at $19.95 per month ongoing, until you, of course, cancel, which I hope never happens. I hope you work with me forever. But again, if you decide you don't like it at some point in the future, just cancel your subscription. It's very simple. So, folks, I hope to be working with you here, and I'll be cranking out the next newsletter tomorrow morning, Saturday, the 15th of November. I hope you've enjoyed this technical analysis of the S&P 500 for Friday, February 14th, 2020. Thank you so much for joining me on this video. If you haven't already done so, please subscribe to my YouTube channel. Give me a thumbs up on this video. Leave a comment, and I look forward to seeing you in the next video.